Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another Economy and Finance 101 video, this time on stock. So what is a stock? So we decided to do a first introductory video with definitions, and then we'll dig into many of the fascinating topics related to stocks. And a special thank you to Adnan Poulin from IA Investment Management for giving us a hand with this video. So let's get started. So what is a stock? Well, let's read the definition together. A stock is a form of security that indicates the holder as proportionate ownership in the issuing corporation. So what that means in plain language is that when you buy a stock, you buy a piece of a company. So you're now a stockholder, a shareholder, so you're one of the owners of this company. Corporations issue or sell stocks to raise funds to operate their businesses. So where do stocks come from? Well, before they're traded on the secondary market, there's an initial public offering from the company where they sell a share of the company to the public through many shares, and then that this money is used to fund the operations of the business, to invest, so everything that the cash needs of the company. So there are two main types of stocks, common and preferred. We'll get to that in a second. Before stocks are bought and sold predominantly on stock exchanges, so what we call the secondary market, though there can be some private sales as well. So then we are talking about private equity, and at IA we do this kind of business, and we even offer some exposure to private equity to our clients. So it would be us making a deal with the company to buy over the counter a share of that business, and not through the secondary market or a stock exchange. So this is private equity. Through the ownership of the stock, the holder may be granted a portion of the company's earnings distributed as dividends. So dividends are profits of the company that are sent directly to you as a perk for being an owner of the company. So common stock versus preferred stock. Common stocks usually entitles the owner to vote at shareholders meetings. So you can vote to, for example, elect the members of the board of directors, and to receive any dividends payout by the corporation. So this is common stock. Preferred stocks usually do not give the holder voting rights. So that's one of the differences, though you have a higher claim on assets and earnings than the common stockholders. So what does that mean? Is that owners of preferred stocks will receive dividends before common shareholders and have priority in the event that the company goes bankrupt or is liquidated. So if things turn out very wrong for the company and it goes bankrupt, then preferred shareholders will have their money before the common shareholders. So that's one of the advantages. So you give some and then you get some. So if we look at market capitalization, so what's market cap? Market cap is the number of shares that are outstanding for a company times the price of one share. So that's the market capitalization of the business. So you always usually hear about large cap, small cap, mid cap. So large cap, these here are the US definitions. There's not a universal definition, but we'll use this one here. Large cap, market value, market capitalization of more than $10 billion. Mid cap between 2 and 10 billion. Small cap between 300 million and 2 billion. So we have a small cap index on the TSX. In the US, it's the Russell 2000. That's the small cap index. So businesses that have these kinds of market capitalization, and a micro cap, or tiny companies that are listed. So a market cap between 50 million and 300 million. So how do we value a stock? So there are many ways to do that, depending on the companies, depending on the manager. They look at different ways, different things. So price to earnings is the most common one. So it's the ratio of the share price, so the price of one share, divided by the earnings per share of the business. So let's say the stock trades at $10 and the company makes $2 of profits per share. That would be a price earnings of 5. So typically, long run average, the stock market tends to trade at somewhere between 15 and 20 on the price earning ratio, somewhere around that. So this is kind of the long term average of the stock market, but it depends on sectors and names. Dividend yield, so it's the amount of money a company pays shareholders for owning a share of its stock, divided by the current stock price. So a high dividend yield usually means that the stock is cheap, and a low dividend rate usually means that the stock is expensive. Price to book, you divide the market's valuation of the company compared to its book value. So we tend to use that mostly now for utilities, so businesses that have a lot of physical assets. Price to sales is a measure that some people like to use because you can play with earnings, you can play with book value on with accounting measures, but you can't really play with sales. So the price to sales is a measure that some people like to use. And finally, the price to free cash flow, which is predominantly used now to value tech companies, is the company's ability to generate additional revenues. So calculated by dividing the market cap by the free cash flow value. So for example, if you're Amazon and you reinvest all of your profits, well, you have profits of zero, but because you reinvest everything, so you need to look at the free cash flow, how much cash flow the company is able to generate. So that's price to free cash flow. So those were the definitions I wanted to cover in this video. So more to come on some specific aspects. And if you have any special requests, just send them to us. You can contact me on LinkedIn. You can contact me on Twitter. You can find our email address at ia.ca/economy. So more to come in the Economy and Finance 101. Thank you for watching, and I'll see you in the next video. Thank you.